So what I want to talk about today is how real estate investors use whole life insurance to buy and sell real estate. We are going to go through a deep dive in this video and look at a lot of numbers, specific models that help answer people's questions such as what's the actual growth rate on my policy? And then what's the growth rate compared to the cost to borrow? And when I look at the net numbers, not a gross dividend rate where on paper it sounds like it'll work well, but when I actually see the comparison, does it work out in my favor or the insurance company's favor? I'd like to see it before I actually put my money into this product. We're going to go through that and a lot more. What I'll start with is a quick story that really paints a nice picture from a conceptual standpoint and attracts a ton of people to this idea, using cash value life insurance to invest in real estate. Back in December of 2019, I was down right outside of Miami, Florida at Grant Cardone's office. It was for a business development event. My company and another 20 to 25 small business owners were at his office. It was for an event. We worked primarily with the Cardone Ventures group, but during that event, one day during lunch or a break, the Cardone Capital group came in. Cardone Capital is one of Grant's real estate companies. They do a lot of real estate investing, primarily in multifamily units. And anyway, the purpose of mentioning that is I'm speaking with one of the individuals who works at Cardone Capital. He asks, what does your company do? I let him know we set up whole life insurance policies for maximum cash value, and then we show people how they can use the policies through the policy loan feature. Money is always at work for you, all the stuff that I talk about in all of our videos. And he goes, that's interesting. You know, we just closed on the biggest deal we've ever had, a huge piece of property. And one of the largest investors on that property actually borrowed several $1,000,000 from his Mass Mutual whole life insurance policy to invest in Cardone Capital. I'm like, you gotta be kidding me. What are the chances of that as I'm having the conversation with the guy? But anyway, it was interesting. It also validated that a lot of people use this strategy. Here we've got an individual with a huge amount of cash value in a life insurance policy, literally using it for real estate investing. On the flip side, however, many people have looked at the strategy. They hear that and they're interested. Okay, if people with millions of dollars are building up cash value life insurance policies where they have millions of dollars there, but then they're using it for real estate investing, it must make sense. But then you've got the savvy investor or someone who's very technical to say, I don't care who does it, it's got to be validated for me on paper. I like to do that myself as well. So we're going to go through just that in this video. What we will begin with is how it works. Most important thing, the actual whole life insurance policy. Before we consider borrowing against the policy, we must make sure to set up properly and positioned with one of the top companies in the industry, your 4 major mutuals to be specific. If it's set up right, meaning with a minimum premium, we talk about policy design all the time, a 10-90 split, as low as we can drive that premium, I can expect the net internal rate of return to fall somewhere between that 3 to 5% net growth rate over time. The core benefits specifically to the cash value are as follows. It is a safe, liquid, tax-free area to position money. Safe, meaning if things are going very, very well or very, very poorly in the stock market and economy, that 3 to 5% is consistent. Liquid, I can access the money anytime I want. And 3, tax-free if, always a big if there, if I do things properly. Meaning I don't trigger a modified endowment contract, I don't cash the policy out with a gain. We've got other content that goes into that. But in line with the second bullet point, in blue, what do we see there? Loan feature and then constant compounding. So a unique feature to a whole life insurance policy is that once a dollar passes through your cash value, if you just let that dollar sit and grow and earn, call it 5%, or if you elect to borrow against it, if you pull money out, you will continue to earn that 5% on your entire cash value, meaning the money that's still remaining in equity, call it, that you have not borrowed, and what you've borrowed. You continue to earn that 5% or whatever the growth rate is on the entire cash value. To demonstrate, let's pretend that you have a policy with $100,000 in cash value and the net growth rate is 5%. 5% of $100,000 is $5,000. So if you did not touch that money, the cash value within 1 year would grow to what? $100,000 at 5%, $5,000 builds up to 105. So now you've got $105,000 in cash value. Let's rewind the clock, going back to when you had $100,000 in cash value. You elect to borrow $50,000 from your life insurance policy. So this is back again when you have $100,000 in cash value. You take a $50,000 loan. You will continue to earn that 5%, assuming that's the net growth rate, as if you still had the full $100,000 and you did not touch anything. Meaning the $50,000 that you've borrowed and also the $50,000 in equity, remaining equity, call it, is still earning that 5%. So to make this example simple, if you pay that $50,000 loan back in 365 days, it would be worth the same 105 in cash value. Meaning I've got constant compounding and no lost opportunity cost. Let's look at an example on this. So this is always good to provide some visuals around. Here, we've got a sample with as follows, a 40-year-old male. We're going to look at a loan and repayment model. Keep this point in mind here. We've got a company crediting a dividend interest rate of 6% and charging a loan interest rate of 3%, just over 3%. It's 3.04% to be precise. But in this example, 40-year-old male, whenever we look at a loan model, what I like to look at every single time first is the policy with no loans whatsoever, just to make sure it's maximized. What does the growth look like? This way, when we actually look at loan models, we can compare it to the growth model and say, okay, how does it impact my cash value? What's it look like when I actually take that loan, when I pay it back? How much do I pay in interest? What's my net internal rate of return? All of that good stuff. We're going to keep things simple in this model. Looking at the first year, from a growth standpoint, is it properly designed? $100,000 goes in. What do we notice here? Just about 90% right off the bat. I've got $89,500 in cash value where I made a $100,000 payment. Depending on the company and product, quick side note here, the first year cash value should typically fall between 80 and 90%, meaning that's about as high as I can get it with most whole life insurance products out there. And why there's that 10% range is because it depends on the company and product selection. But here we've got a prime example of that, a policy designed for maximum cash value. So just about 90% right off the bat. Continues to make $100,000 per year payments, pays into it for a total of 10 years. So a total of $1 million goes in. But what do we see here? Year 4, he's cash positive. He's paid in $400,000 and he has $400,000. I also like to refer to this as his break-even point. So this is the growth model here, but let's compare it to the loan scenario. So over here, we take out an annual loan, one-time loan here of $300,000. Let's assume that this is you, and you say, hey, I've got an investment over here that I feel can produce me 12% over here in real estate. So I'm going to borrow $300,000, use it for my real estate deal, or I'm going to earn 12%. While at the same time, I'm going to earn this 6% dividend. Does a 6% dividend result in a 6% earnings rate? No, it does not. We'll touch on that a little bit later. But back to the loan, we take out $300,000. What's the impact that it has on my policy? Look at your cash value and death benefit and compare that to this guy over here. So when I don't touch the money, my cash value, year 5, is $515,000. My death benefit's 2.271. In the example where we borrow $300,000, what is the impact of that loan? We see the cash value drops by just about $300,000. The death benefit does as well. Anytime you take a policy loan, you will find with every insurance company out there, your death benefit will be reduced dollar for dollar by the amount you borrow. The reason why is that the death benefit is held as collateral when you take a policy loan. That is a key reason why, I should say how, insurance companies are able to continue to credit you the same guaranteed rate and dividends on your entire cash value as if you never touched it in the first place. They're holding your death benefit or a percentage of your death benefit as collateral. That's why we see the reduction there. Now in this example, here's your loan interest, a little over 3%. What do we see here? The interest comes due, and we're assuming that we pay it each year. Also, we've got the loan principal repayment at $30,000 per year. Now, we can repay that loan however and whenever we want. I just plugged in $30K per year here, mainly for simplicity. But what do we notice here? What happens when that loan's fully repaid? Cash value is $1.5 million. Death benefit is just over $2.5 million. Compare that to the same point in time, that's year 15. And what do you notice here? 1.507, death benefit's 2.555. The numbers are identical. So just like that example where we looked at it in 1 year, when we took that loan of $50,000 and pay it back, if my $100,000 is going to be worth 105 in 1 year, regardless if I let it sit and grow or if I borrow and then repay, it's still worth the same 105. The model we just looked at there, this is a policy, so an illustration we ran, and just dropped it all in Excel, exact same thing here. So we have that constant compounding, no lost opportunity cost. My money constantly remains at work for me. Going back to real estate investors, that attracts a large percentage of them. Hey, my money constantly compounds. So what is sometimes used, call it as a sales pitch, which I found some people actually very disgruntled about this, particularly those that are paying in 7 figures per year into life insurance policies, is this. They hear, you can earn 5% on your whole life insurance policy and you can double dip, meaning you can borrow against it and invest in real estate. And if you're earning 12% or whatever the return is, let's assume it's 12%, you're earning 12% with your real estate and 5% in the policy, which gives you a return of 17%. Not everyone likes that. This has caused or resulted in a pain point for many individuals. And the main objection there is you're not accounting for the cost of interest. What is the actual cost to borrow? Is it a wash on the amount of money that I loan? And here's what I want to touch on this, especially if you're in the business and saying, wait a minute, in some ways I am double dipping. Doesn't matter what our thoughts or opinions are on it. Look at the numbers and what is the consumer interested in? What are they looking at? What are their accountants and tax attorneys looking at? Remember, we have to be on the side of the consumer. We're going to come back to this, but this objection, I've seen it many, many times, and we'll come back to it. Otherwise, I'll just ramble on. So, some benefits here. Why people are attracted to it. A lot of times we'll see investors use cash or equity that is purposed for deals, for real estate deals. They'll say, wait a minute, I've got money in cash that's earning 0%, perhaps 1% at best if I've got a bank that's generous. But if I've got money in cash, it's not really doing anything for me. So now I can reposition cash into a whole life insurance policy, actually see it produce a positive return over time, much better alternative than just having money in cash. People are attracted to that. Many people like the guarantees. The growth rate's better than cash. Now on that point, what I want to touch on here, using this example, it is better than cash as time passes. However, if I'm being objective and what some have pointed out, first year, that's worse than cash. And this is a policy that's beefed up for early cash value. I pay in $100,000, I've got about 90% of it. That's a 10% loss. If this is 7 figures, I pay in $1 million, what's 10%? That's $100,000. If it's a $10,000 payment, I only see about $9,000 in cash value. That's a negative hit. And the question that is raised, and we should be raising for people as well, and this might sound like I'm saying don't by the product that I sell, but I'm just trying to be transparent here more than anything else, is point this part out. What are the drawbacks? This is a negative feature of whole life insurance that people don't like. Point it out, discuss it, make sure someone's comfortable with it. If they're not, that's okay. So if you're considering a policy, if you're not comfortable with that, that's okay. If you are, you say, hey, long term, I do overcome this. It's worth the upfront hit. I'm comfortable with that. But if you're not, there's nothing wrong with it. It's just giving everything a shot at the end of the day. That's how I like to look at things. Continuing on here. So no management, specifically on the time. This is a very, very easy asset to manage. Doesn't really require much work. The loans are easy to request. I get them anytime. With respect to the actual cash value growth, there's no management at all. Each year, I get my annual statement. I see the dividend that was paid. My cash value grew by how much? What's the internal rate of return? Very, very simple. And your agent can always provide information as well. The tax benefits are very attractive to people. Going with a third core benefit there, tax-free if we do everything properly, meaning we don't trigger a taxable event, and then it's very easy to access going back to the loans. So where people like this, where they view it as a huge benefit, is if someone's used to working with banks and lenders, they know that banks and lenders can sometimes kill deals. It's not intentional, but sometimes I try to get a loan or qualify for a loan with a bank or a lender. I'm told it will take 2 to 4 weeks. It takes 3 to 6 months. The time has passed. The deal is no longer available because the loan took too long. It can be extremely frustrating. Maybe I had a line of credit for $1 million and the bank gradually decreased it to now it's $250,000. We've heard those types of stories. Where here, I've got much, much more control at the end of the day with the policy. So that is a benefit that a lot of people are attracted to with these products. Some other benefits. The constant compounding, we touched on that already. Money at work while it's also in real estate. So the money in the policy is compounding at whatever rate it's compounding at, while at the same time it's in real estate. Or me personally, I don't use my policies too frequently for real estate. I use them more so for my business. Same thing, because that's the bulk of my returns, or my greatest return, I should say, is my business at the end of the day. Side benefit in gold, the death benefit can cover any mortgages or lines of credit I have outstanding with a third-party lender, or with a bank in this case. The growth is tax-free. We touched on that with the tax benefits. Now here's one other thing I want to touch on. Tax-deductible loan interest, but what do we have an arrow pointing to? Cash value collateral loans. So if you have a life insurance policy, and we're not considering cash value collateral loans, you take a loan against it. The loan interest rate is 5%, whatever the cost to borrow is. If you're using that for business, is it tax deductible? Here's the thing. CPAs sometimes say, yes, you can deduct the loan interest if it's used for business purposes. The IRS does not like loan interest from life insurance policies deducted. It is something they're going to look at more closely than other items. So as a consumer, do I want the IRS looking over my shoulder and looking at what I'm doing and questioning things? If I have a good CPA in my corner, okay, that does give me some peace of mind, some comfort. That's perfectly fine. But at the same time, I want that awareness to know, okay, the IRS does not allow loan interest to be deducted on life insurance policies. However, CPA says if you're using it for business, then legitimately you can do it. Some CPAs say, I wouldn't deduct it. I wouldn't even go down that route. So, not to say it's a gray area, but I do want awareness with respect to what the IRS likes and does not like. None of this is tax advice, as I'm not a tax professional by any means, just for full disclosure there. With all that said, cash value collateral loans, which involves me taking my life insurance policy to a bank, to a lender, assigning the cash value to the bank as collateral, then they give me a loan, typically a line of credit against the cash value. I can check off on the bank's paperwork. Is this loan for personal use or is it for business use? If it's for business use and I check that box off, that does generate a tax deduction. It's usually a lower loan interest rate than what I'll get with a direct policy loan as well. So now I can have a positive growth rate, a lower loan interest, so I've got a positive spread here, a higher growth rate than what I'm paying in loan interest, and deduct the interest. That's where it can be quite attractive. So what real estate investors will kind of summarize sometimes is, hey, if I don't need the life insurance product, like I'm doing fine without it, if it improves my overall situation, I'm interested. If not, hey, no harm, no foul. I like that approach, and I try and take that approach myself with things. So those are some benefits there. Let's move on to some objections here and have some fun. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.